1.3 million users, $33 million. Backed by Andreessen Horowitz's crypto fund, Google's chief scientist, the co-founders of Twitter and Pinterest, and over 45 Silicon Valley angels. And yet, dead in less than a year. This is the story of Yup.ai, a startup that had every possible advantage, massive scale, and deep pockets, and still couldn't survive long enough to matter. If you want to understand why the AI startup graveyard is filling up so fast, this is the case study that explains it. Let me start with what Yup.ai was supposed to be. In June 2025, Yup launched with a simple but ambitious premise: build a marketplace where users could test and compare outputs from over 800 different generative AI models. Think of it as a democracy of AI. Users could chat with ChatGPT, Claude, Gemini, Mistral, and hundreds of other models all in one place. They could see which model gave the best answer to their question. They could rate the responses. They could leave feedback. And here's the business model. That feedback, aggregated and anonymized, becomes incredibly valuable data. AI labs want to know how their models perform in the real world against competitors. Yup would collect millions of preference data points monthly and sell that intelligence to OpenAI, Anthropic, Google, and other foundation model companies. It was, on paper, a genuinely clever idea, a two-sided marketplace. Users get free access to all these models. AI labs get real-world evaluation data. Everybody wins. So why did investors move so fast? Because the pedigree was undeniable. Co-founder Pankaj Gupta had been a VP and advisor at Coinbase. His co-founder, Gilad Mishne, came from Google. The seed round, announced in June 2025, closed at $33 million. That's enormous for a seed round. But look at who wrote the checks. Chris Dixon leading the round from Andreessen Horowitz's crypto fund. That's a signal. Then came the angels. Jeff Dean, chief scientist at Google DeepMind; Biz Stone, co-founder of Twitter; Evan Sharp, co-founder of Pinterest; Aravind Srinivas, CEO of Perplexity AI; Kunal Shah from Cred. This wasn't a normal startup. This was a startup that had literally every advantage money and connections could buy. And it worked. For a moment, Yup hit 1.3 million users in less than a year. They maintained a public leaderboard showing which models performed best on various tasks. They had several AI research labs as paying customers. On the surface, it looked like a classic startup success story, the kind of hyper-growth narrative that gets featured in TechCrunch and celebrated at conferences, the kind of story where if you'd gotten in early, you'd be rich. But here's what users and investors couldn't see from the outside. The business model was broken, and the market was moving faster than the company. On March 31st, 2026, less than a year after launch, Pankaj Gupta posted the shutdown announcement. Quote, "We signed up more than 1.3 million users and several labs as paying customers, but we didn't reach a strong enough product market fit. The site would remain available until April 15th for users to download their data. That was it. $33 million. 45 angel investors, 1.3 million users. Done." So what actually happened? According to Gupta's statement, the core problem was simple. The market changed faster than Yup could adapt. Models got dramatically more capable. But more importantly, the future of AI stopped being about comparing chatbots. The future became agentic systems, models connected to tools, to memory, to real-world APIs, the kind of AI that can not just chat, but act. Think of Claude with code execution, or ChatGPT with the ability to browse the web, or any AI assistant that can actually do things beyond generating text. When AI was just chatbots, Yup's marketplace made sense. Test outputs, rate them, compare them. But when AI becomes agentic, when models are integrated deeply with tools and data sources, the idea of comparing raw model outputs in isolation becomes less valuable. It's like comparing engines when what customers actually care about is the whole car. This is the harsh reality of the AI startup era. The technology moves so fast that a perfectly good business model can become obsolete before you even prove it works. Yup didn't fail because of bad execution or a weak team. It failed because the ground beneath the business model shifted. But there's a deeper lesson here, and it's about the venture capital assumption that shapes so many startups. The assumption is this: big raise plus smart team plus good network equals success. It's a pattern that worked in previous eras, and so investors keep applying it. Yup got all three of those things in spades. $33 million? Check. The team included ex-Google, ex-Coinbase? Check. Angels from Twitter, Pinterest, Google DeepMind? Check. And yet, none of it mattered because the business model itself was racing against a moving target. Here's what the failure reveals. In fast-moving fields, the quality of the team and the size of the capital matter far less than the sustainability of the business model. Yup had two of the three, but their core insight that preference data would be valuable to AI labs became less valuable the moment model companies started building agentic capabilities natively. This pattern is showing up again and again in 2026. Companies with massive funding, amazing teams, millions of users, shutting down because the underlying market shifted before they could monetize. It's different from the Builder.ai story, where the company was committing outright fraud. Yup was honest. They tried, they adapted, they failed anyway because the AI landscape moved faster than they could keep up. And here's the final irony. The data Yup was collecting could have been incredibly valuable, but only if the market had stayed still long enough for them to monetize it. As it was, they built a data asset that became worthless the moment the industry pivoted to agentic systems. Pankaj Gupta, to his credit, was reflective about it. In his wind-down statement, he acknowledged that startup experience teaches you to recognize what's not working and make hard decisions early. He said he's taking a 2-year break, which is fair. When you've been a founder multiple times, lost $33 million, and seen the market move past your idea in 11 months, a break makes sense. As for the team, some joined well-known AI companies, which is probably the only play that made sense. If you've built a marketplace for AI evaluation and the world doesn't want that anymore, you might as well work for the people who are actually building the future they identified. So what are the actual lessons here? Lesson 1. Speed of technology change destroys business models faster than we expect. The VC playbook assumes you have time. You raise money, you scale, you figure out the business model. But in AI, by the time you figure out the model, the underlying technology has moved on. Yup was built for a 2025 world. By 2026, the world had changed. Lesson 2. Celebrity investors and connections are not de-risking factors anymore. Yup had some of the most connected people in tech backing it. It didn't matter. The team was great. It didn't matter. Sometimes the market just doesn't cooperate, and no amount of social proof can protect you. Lesson 3. When you're building a marketplace or platform business in a fast-moving space, be extremely skeptical of your thesis. Yup's thesis was that raw model comparison data would be valuable. It's easy to imagine scenarios where that's true, but in a market changing as fast as AI, that premise can evaporate in months. You need optionality. You need multiple revenue paths. Yup had one path and it stopped working. And lesson 4, maybe the hardest one. Sometimes your idea is good and your execution is good and your team is good, and you still fail. Not because you did anything wrong, but because the world moved on. That's a different kind of failure than most founders are trained to handle. It's not about pivoting harder or working smarter. It's about realizing that sometimes the game changes before you finish playing it. The Yup.ai story sits somewhere between cautionary tale and honest portrait of the AI era. The company didn't lie about what they were building. They didn't fake their metrics or misuse investor money. They built something real, got real users, secured real customers, and it still wasn't enough because the market shifted too fast. For every Quibi or Builder.ai that fails due to fraud or fundamental dishonesty, there's a Yup, a company that failed because the technology landscape evolved faster than the business model could adapt. Maybe that's the real lesson of the 2026 AI reckoning. The danger is not always the company that's lying. Sometimes it's the one that was honest about the wrong thing at exactly the wrong time. If you're building in this space, the takeaway is simple. Don't just test your product, test your assumptions about the future. Because if Yup taught us anything, it's that AI moves so fast that the best idea in June can be obsolete by March. The companies that survive will be the ones that don't just adapt to change. They'll be the ones building for it from day one. If this case study resonated with you, subscribe for more deep dives into startup failures. Every week, we analyze another collapse, and every analysis comes with lessons you can apply to your own work. Drop a comment if there's a company you want us to break down next. Thanks for watching, and I'll see you in the next one.